Hello and welcome to your ultimate guide for the Pennsylvania Real Estate Salesman Examination. My goal today is simple: give you everything you need to fully understand the key concepts, master them, and walk into your exam with total confidence. In this video we'll cover title transfers, co-ownership estates, property valuation, real estate finance, contract law. With over 100 plus success stories, we have proven our videos will help you pass your exam on the first attempt. And remember, our website offers free exam guides and practice questions to help you ace your exam. You'll find the link in the description below, so be sure to check it out and get the resources you need to study smarter, not harder. So let's get started.
Question 1. A title search reveals a misspelled name and an old, possibly invalid mortgage clouding the title. Which deed is typically used to release such doubtful interests? Your options are A. A quitclaim deed, B. A general warranty deed, C. A special warranty deed, D. An executor's deed. Which one is it? Pause the video if you need more time. The correct answer is A. A quitclaim deed is correct because a quitclaim deed conveys only whatever interest the grantor may have, with no warranties. That makes it the standard tool for curing a cloud on title, such as releasing a doubtful claim or correcting a name. B is wrong because a general warranty deed is used to convey ownership with full covenants of title. It is meant for a normal sale, not for releasing a questionable interest that a party may or may not actually hold. C is wrong because a special warranty deed conveys title with limited covenants for the grantor's period of ownership. Like a general warranty deed, it is a conveyance instrument, not the usual device for clearing a recorded cloud. D is wrong because an executor's deed conveys estate property by a personal representative during probate. It addresses transfers from a decedent's estate, not the release of a misspelled name or stale mortgage clouding a chain of title. A quitclaim deed simply transfers whatever interest the grantor holds, nothing more, nothing less. It carries no promises about the quality of the title, and the grantee accepts the release knowing there is no guarantee attached. A warranty deed binds the grantor to covenants, break one, and there is real liability. A quitclaim makes none of those promises, which is exactly why someone with a doubtful or uncertain interest will sign one freely, stepping away with no exposure. When a chain of title shows a gap, a misspelled name, or an old mortgage never formally satisfied, the record carries a cloud. The quitclaim clears that cloud by getting the doubtful party to formally release whatever interest they might hold, without ever admitting the interest was valid. Rank the three deeds by the protection a grantee receives. General warranty at the top covering all prior owners, special warranty in the middle covering only the grantor's period, and quitclaim at the bottom with no warranties whatsoever. On a licensing exam, signal words like cloud, release, cure, misspelled name, or possible heir point straight to the quitclaim. When the scenario describes a buyer paying full market value who wants protection, the quitclaim is the wrong answer every time. Question 2. Two streets of nearly identical homes face each other across a river, yet one side commands higher prices. Which economic characteristic of land best explains this? Your options are A. Indestructibility, B. Immobility, C. Non-homogeneity, D. Area preference. Take a second. Which answer would you pick? The correct answer is D. Area preference. D is correct because area preference, also called situs, reflects people's preference for one location over another based on convenience, reputation, schools, and views. It is the economic characteristic that best explains why comparable homes sell for different prices. A is wrong because indestructibility means the land itself endures even when buildings decay or are demolished. It speaks to land's physical permanence, not to why buyers will pay more to sit on one side of a river. B is wrong because immobility is the physical fact that a parcel cannot be moved from its location. Examinations pair it with situs to trip candidates, but immobility does not by itself drive the price gap between the streets. C is wrong because non-homogeneity means no two parcels are exactly alike. While true of every lot, that uniqueness is a physical trait and does not capture the market preference that lifts one street's prices above the other. Situs, or area preference, is the economic characteristic that explains why one location commands a higher price than another. It has nothing to do with the physical dirt. It's about where that dirt sits relative to everything people value. Land is studied through two sets of characteristics. Physical traits describe what land simply is. It can't be moved, destroyed, or duplicated. Economic traits describe how land behaves in a market. Situs belongs to the economic side because it only exists when people and markets assign it value. Imagine two physically identical parcels separated only by a school district boundary. The land is the same, but one parcel carries a higher price purely because buyers prefer to be on that side of the line. That is situs in action. Situs builds through accumulated human judgment. A great school district attracts families, supporting local businesses and lifting desirability further, because the supply of land in any prime spot is fixed. Rising demand has nowhere to go but into price, which is why a celebrated address can far exceed what the building alone would ever justify. The classic exam trap is confusing situs with immobility. Immobility is the physical fact that land cannot be relocated. Situs is the market's verdict on where people want to be. When a question holds physical features constant but still shows a price difference, situs is always the answer. Question 3. 3 people hold title as joint tenants with right of survivorship. When one of them dies, what happens to that deceased owner's interest? Your options are: A. It passes to the surviving joint tenants. B. It passes to the deceased's heirs. C. It escheats to the state. D. It becomes a life estate. Before I reveal it, which one do you think is right? The correct answer is A. It passes to the surviving joint tenants. A is correct because the defining feature of joint tenancy is the right of survivorship. When one joint tenant dies, that interest passes automatically to the surviving joint tenants, outside the will and outside probate, until one survivor may hold the whole. B is wrong because passing to the deceased's heirs describes a tenancy in common, which has no survivorship. In a joint tenancy, the survivorship feature defeats inheritance, so the interest does not go to the deceased owner's heirs. C is wrong because escheat occurs only when an owner dies with no will and no heirs at all. Here surviving joint tenants exist and automatically take the interest, so the property does not pass to the state. D is wrong because a life estate is an ownership interest measured by a lifetime, not a result of one joint tenant's death. Survivorship simply shifts the deceased's share to the survivors. It does not create a life estate. Joint tenancy is a special form of co-ownership built around one defining power, the right of survivorship. Understanding how that right works, and why the law imposes strict conditions on it, is the key to mastering this topic. To create a joint tenancy, the law requires 4 unities, remembered by the word pit: possession, interest, time, and title. All 4 must be present simultaneously. Remove any single unity and the joint tenancy collapses, converting into a tenancy in common instead. When a joint tenant dies, their interest does not pass through a will or to heirs. It vanishes from the decedent instantly and is absorbed by the surviving joint tenants. Each survivor now holds a larger undivided share, automatically by operation of law at the moment of death. The critical contrast for any exam is survivorship versus inheritance. In joint tenancy, a share moves sideways to the living co-owners. In tenancy in common, it moves down to the dead owner's heirs. Tenancy by the entirety, available only to married couples, also carries survivorship but adds extra protections. Because survivorship operates at the instant of death, a joint tenant will simply cannot reach that share. It has already shifted to the survivors before the will can speak. No probate, no heirs, no exceptions. Question 4. Two unmarried friends take title together without stating any form, each holding an undivided share that passes to heirs at death. Which co-ownership form is presumed? Your options are A. Joint tenancy, B. Tenancy by the entirety, C. Ownership in severalty, D. Tenancy in common. What's your answer? Commit to one before I continue. The correct answer is D. Tenancy in common. D is correct because tenancy in common is the default form when co-owners take title without specifying otherwise. Each holds an undivided, possibly unequal share with no survivorship, and at death that share passes to the owner's heirs. A is wrong because joint tenancy requires express words of survivorship and the 4 unities, and it is not presumed. Without clear intent to create survivorship, the law defaults to a tenancy in common for the two friends. B is wrong because tenancy by the entirety is available only to a married couple treated as one legal entity. Because the two are unmarried friends, this form cannot apply regardless of how they take title. C is wrong because ownership in severalty is ownership by a single person or entity alone. Here, two people share title together, so the property is co-owned rather than held in severalty by one owner. Tenancy in common is the law's default form of co-ownership. Tenancy, the arrangement that kicks in automatically whenever 2 or more people take title together without specifying how they hold it. Understanding why it's the default and what that means for each owner is essential for any property law exam. Each tenant in common owns an undivided fractional interest, meaning no owner controls a specific corner, but each may use the whole property. Shares can be unequal, and crucially, every share is fully inheritable. When a co-tenant dies, that interest passes to their heirs or by will, never automatically to the surviving co-owners. Because the interest is undivided, neither owner can claim a specific portion of the physical property. Both have full rights to the whole, and when one owner dies, their fractional share descends to heirs or through a will, leaving the surviving co-owner's share completely unchanged. The law treats tenancy in common as the fallback because survivorship, which cuts off a person's heirs, is too serious to impose by accident. Silence on the deed means no survivorship. Joint tenancy and its right of survivorship require express language. The law will never read that consequence into a deed that stays quiet. On an exam, the signal words matter. A deed that is silent on the form of ownership, or describes unequal shares or inheritance by heirs, points to tenancy in common, only when a stem expressly states a right of survivorship, or describes a married couple taking title as a single unit. Do you shift to joint tenancy or tenancy by the entirety? Question 5. A developer buys 3 adjoining lots and combines them, and the merged tract is worth more than the sum of the separate parcels. What is this increment called? Your options are A. Plottage, B. Assemblage, C. Accretion, D. Contribution. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Plottage. A is correct because plottage is the increment of value created when combined parcels are worth more than the sum of their parts. The act of combining the adjoining lots is assemblage, and the added value that combination produces is plottage. B is wrong because assemblage is the process of combining adjacent parcels under a single ownership. It names the act of merging the lots together, while the extra value that results from creating the larger site is what is called plottage. C is wrong because accretion is the gradual increase of land caused by waterborne soil deposited along a bank. It is a natural process tied to a watercourse, not the value gained from deliberately joining several lots into one larger tract. D is wrong because contribution measures what a single improvement adds to the value of the whole property. It evaluates a feature's marginal value, not the surplus created when separate parcels are assembled into one larger holding. When separate parcels are merged into a single larger tract, something interesting happens to value. Understanding why requires knowing two paired terms, assemblage and plottage. Assemblage is the process, physically combining two or more contiguous lots under one ownership. Plottage is the financial reward, the increment of surplus value that appears because the merged parcel can now support a higher and more profitable use than any individual lot could. Picture 3 narrow lots, each worth a modest amount as single home sites. Assembled into one wide parcel, the combined site qualifies for a mixed-use building, shops below, apartments above, appraising for far more than the 3 purchase prices added together. That surplus is the plottage increment. Exam writers test whether you can separate plottage from similar sounding concepts. Progression and regression describe value shifts caused by surrounding properties, external forces. Plottage is internal. It springs entirely from the owner's own decision to merge parcels into something larger and more useful. Remember, plottage only exists when the larger combined size actually enables a better use. Simply owning adjacent lots without any improved use creates no plottage increment. The whole must genuinely become worth more than the sum of its parts. Question 6. A tenant remains in possession after the lease term ends, without the landlord's consent and against the landlord's wishes. Which estate does the holdover tenant hold? Your options are A. An estate for years, B. A periodic estate, C. An estate at sufferance, D. A fee simple estate. Which would you go with? Lock it in before the reveal. The correct answer is C. An estate at sufferance. C is correct because an estate at sufferance arises when a tenant who lawfully took possession holds over wrongfully after the lease ends, without the landlord's consent. It is the lowest estate and the holdover is little better than a trespasser. A is wrong because an estate for years is a tenancy for a definite term that simply ends on its stated date. Once that term expired and the tenant stayed without consent, the estate for years no longer describes the occupancy. B is wrong because a periodic estate would arise only if the landlord accepted continued rent, converting the holdover into a renewing tenancy. Because the landlord objects, the wrongful holdover remains a tenancy at sufferance instead. D is wrong because a fee simple estate is full ownership, not a tenant's interest at all. A holdover tenant possesses nothing approaching ownership, so the fee simple label cannot apply to the situation. An estate at sufferance is the lowest recognized possessory interest in real property. It arises when a tenant enters lawfully under a lease, but then stays past the end of the term without the landlord's permission. This puts the holdover in a unique legal limbo. Not quite a tenant, not quite a trespasser. What makes this estate unusual is that the original entry was legal. The law can't call the holdover a trespasser because they had every right to be there at first. But calling them a tenant would overstate a relationship that has already ended. The estate at sufferance fills that narrow gap. The holdover sits in a fragile position. The landlord can accept rent, which converts the sufferance estate upward into a new periodic tenancy. Or the landlord can refuse and pursue eviction, which ends the occupancy entirely. The estate continues only until the landlord acts. Picture a lease that quietly runs out at midnight. The tenant doesn't leave and no renewal is signed. The landlord hasn't yet acted. That stretch of time after the lease ends, before the landlord responds, is exactly where the estate at sufferance lives. On an exam, watch for holdover remains after the lease ends and without consent. If the tenant started legally and stayed past the term with no permission, that's sufferance. If instead the tenant stays with the landlord's blessing but no fixed term, that shifts to an estate at will, a common trap. Question 7. A buyer wants protection against hidden risks such as a forged deed or an undisclosed heir already in the chain of title. Which product covers these? Your options are A. A home warranty, B. Hazard insurance, C. An appraisal, D. Title insurance. Don't overthink it. Which one feels right? The correct answer is D. Title insurance. D is correct because title insurance is an indemnity policy that, for a one-time premium paid at closing, protects the insured against covered losses from title defects existing before the policy date, including forgery, undisclosed heirs, and recording errors. Our is wrong because a home warranty covers the repair or replacement of systems and appliances after closing. It addresses mechanical breakdowns, not defects in the ownership history such as a forged deed or a missing heir. B is wrong because hazard insurance protects against physical loss to the property from fire, storms, and similar perils. It covers damage to the structure, not legal flaws hidden in the chain of title. C is wrong because an appraisal estimates market value for a buyer or lender. It analyzes price and condition and provides no protection at all against hidden defects in the property's ownership history. Title insurance is unlike any other policy a buyer encounters at closing. Instead of guarding against something that might happen tomorrow, it reaches backward into the property's history to cover hidden defects that already existed the day the policy was issued. The classic defects are a forged deed, an undisclosed heir, a recording error, or a lien that was never cleared. These risks lurk invisibly in the chain of title. No title search, however careful, can find a fraud designed to stay hidden. Coverage is purchased with a single premium at closing and lasts as long as the insured holds an interest. An owner's policy protects the buyer's equity up to the purchase price, while a lender's policy protects the loan balance and follows the mortgage. The key exam contrast is this: title insurance covers legal ownership risk from the past, not physical risk and not future events. Hazard insurance covers future damage to the structure. A home warranty covers system breakdowns after closing. And a survey reveals boundary problems. None of those reach backward like title insurance does. Whenever an exam stem describes a forged deed, an undisclosed heir, or any defect already buried in the chain of title, the answer is title insurance. It alone protects the legal soundness of ownership itself, covering the hidden risks of the past. Question 8. A licensee prepares an estimate to help a seller set a listing price, comparing recent solds, active listings, and expired listings. What is this called? Your options are A. Comparative market analysis, B. An appraisal, C. A WISPAP report, D. An evaluation. Got a guess? Lock it in. The correct answer is A. A comparative market analysis. A is correct because a comparative market analysis is prepared by a licensee to help a seller set a price, comparing recently sold, currently listed, and expired properties. It is an informed pricing tool and is expressly not a formal appraisal. B is wrong because an appraisal is a formal opinion of value that only a licensed or certified appraiser may perform to professional standards. A licensee's pricing comparison is not an appraisal and must never be represented as one to a client. C is wrong because a use PP report is the formal appraiser report an appraiser issues under the professional standards. A licensee's market analysis does not follow those standards and cannot serve as a substitute for that kind of report. D is wrong because an evaluation is a least formal value estimate that a lender may use below the appraisal threshold. It is a lending tool prepared for the lender, not the seller pricing comparison that a licensee assembles for a listing. A comparative market analysis, or CMA, is a pricing tool a real estate licensee prepares to help a seller choose a listing price. It's grounded in current market behavior, not formal appraisal standards, and it's built specifically for the listing stage. The licensee draws from 3 reference groups. Recently sold homes show what buyers actually paid. Active listings show today's competition, and expired listings reveal the price ceiling the market refused. Blending all 3 produces a realistic suggested range. The critical distinction is between a CMA and a formal appraisal. A licensee prepares a CMA to guide a seller's listing decision. A state-licensed appraiser performs an appraisal under professional standards, typically for a lender determining how much to lend. They are not interchangeable. On an exam, watch for signal words. Help the seller set a price. Recent solds, active and expired listings, and licensee prepares. Those phrases point to a CMA. The moment a STEM mentions a licensed appraiser producing a formal opinion for a lender, the tool shifts to an appraisal instead. The lasting contrast comes down to authority and purpose. A CMA is the licensee's market-based pricing aid aimed at the seller. An appraisal is a formal valuation governed by professional standards and aimed at a lender or court. Know which tool the situation calls for. Question 9. An owner of an oddly shaped lot near Allentown cannot meet a setback and seeks permission to deviate because of that unique hardship. What is being requested? Your options are A. A non-conforming use, B. A buffer zone, C. A variance, D. A subordination. Which one is it? Pause the video if you need more time. The correct answer is C. A variance. C is correct because a variance permits an owner to deviate from a strict zoning requirement because compliance would impose a genuine hardship unique to that parcel. An oddly shaped lot that cannot meet a setback is a classic basis for one. A is wrong because a non-conforming use is a use that lawfully predates a zoning change and is allowed to continue. The owner here is not continuing an old use but seeking relief from a dimensional rule for a new project. B is wrong because a buffer zone is a strip of land or landscaping that separates incompatible uses. It is a planning device between districts, not the relief an individual owner requests to build despite a setback hardship. D is wrong because subordination is an agreement that changes the priority of liens, so a senior lien yields to a junior one. It concerns financing and recorded claims, not permission to deviate from a zoning setback requirement. A variance is official permission to deviate from a zoning ordinance when applying the rule literally would impose a unique, unnecessary hardship on a specific property. Understanding how variances work and how they differ from other land use tools is essential for the exam. The classic variance scenario involves a parcel whose unusual geometry, like a triangular or steeply sloping lot, makes it nearly impossible to satisfy a standard dimensional rule such as a setback. Even when the owner's intended use is perfectly allowed by the zoning district, to win a variance, the owner must prove 3 things to the local zoning hearing board. The hardship is genuine and arises from the land's own characteristics. It is unique to that parcel and not self-created, and the relief requested is the minimum necessary to allow reasonable use. The key exam contrast is among 4 tools. A variance excuses a dimensional standard because of hardship. A A special exception allows a conditionally listed use. A non-conforming use is a lawful pre-existing holdover, and rezoning actually changes the rules for the entire district. When an exam stem describes an owner who cannot meet a setback or height limit because of the parcel's own peculiarity, the answer is a variance. If it describes approval for a conditional use or a change to the district's rules, think special exception or rezoning instead. Question 10. An income property earns rent that an investor buys for its return. Which approach is the primary method for valuing it? Your options are A. The cost approach, B. The sales comparison approach, C. The square foot method, D. The income approach. Take a second. Which answer would you pick? The correct answer is D. The income approach. D is correct because the income approach is the primary method for investment and commercial property, because such property is purchased for its income stream. The appraiser converts the property's net operating income into value using a market-derived capitalization rate. A is wrong because the cost approach suits new or special purpose property valued as land plus depreciated improvements. An investor buys income property for its returns, so the income it generates, not its construction cost, drives the value. B is wrong because the sales comparison approach leads for owner-occupied homes with many comparable sales. Investment property is valued chiefly by the income it produces, so comparison to home sales does not dominate its valuation. C is wrong because the square foot method is a way to estimate construction cost within the cost approach. It is a costing technique used inside one approach, not the approach used to value a property by the income it earns. The income approach is the method appraisers use to value property that exists to generate rent. The core logic is simple. An investor buying income property is really buying its future stream of rent, so the property is worth what that income stream is worth today. The math has three moving parts. Net operating income is the rent remaining after operating expenses. The capitalization rate is the return investors in that market demand. Divide NOI by the cap rate and you get the estimated value. Higher income raises value. A higher required return lowers it. Picture rent flowing out of a building into a net income figure. Then that figure divided by the market's required return to land on a value. The higher the income and the lower the demanded return, the higher the price an investor is justified paying. The three valuation approaches each fit a different property type. Sales comparison matches homes to recent comparable sales. The cost approach values new or special purpose buildings by land plus rebuild cost minus depreciation. The income approach belongs to investment property, whenever the buyer is an investor and the motive is cash flow. On an exam, the signal is any stem describing rent, an investor, and a property held for return. Those words point squarely to the income approach. The nature of the property and the buyer's motive always identify the right method. Question 11. An aging house sits on land zoned for retail and the site is worth most as a store location. Which principle directs valuing it for that use? Your options are A. Highest and best use, B. Conformity, C. Regression, D. Substitution. Before I reveal it, which one do you think is right? The correct answer is A. Highest and best use. A is correct because highest and best use is the legally permitted, physically possible, financially feasible, and maximally productive use of a site. A property is valued as if devoted to that use, which may differ from how it is currently being used. B is wrong because conformity holds that value is maximized when a property is reasonably similar to those around it. It addresses how a property fits its neighborhood in style and size, not the principle that selects the most productive use of a site. C is wrong because regression describes how a superior property loses value when surrounded by lesser ones. It explains a neighborhood effect on a building's worth, not the rule that a site should be valued for its most productive available use. D is wrong because substitution says a buyer pays no more than the cost of an equally desirable substitute. It sets a price ceiling and underlies the three approaches, but it does not identify which use of the site is most productive. Highest and best use is the appraisal principle that ties a property's value to its most profitable legal use, not to whatever happens to be sitting on it today. Understanding this principle means understanding the 4 tests every candidate use must pass. The 4 tests run in strict sequence. A use must first be legally permitted by zoning or deed, then physically possible given the site's size and soil, then financially feasible to justify its cost, and finally maximally productive, yielding the highest residual land value among all uses that cleared the first 3 filters. Picture an aging house on a busy corner zoned for retail. As a residence, it draws modest interest, but as a retail site, it commands far more because it feeds on commercial traffic the house ignores. The appraiser looks through the existing structure to the store the corner could host. The key insight is the gap between current use and ideal use. An existing improvement can actually subtract value if it must be demolished to unlock the land's full potential. The appraiser's job is to measure the ground against its best legal use, not its present and possibly outdated one. Highest and best use frames the entire appraisal. Whenever a property is clearly worth more under a different permitted use than its present one. This is the principle at work. Distinct from contribution, substitution, or conformity, which each measures something narrower. Question 12. Pennsylvania abolished common law dower and courtesy, and instead lets a surviving spouse claim a fixed fraction of the deceased spouse's estate. What is this right called? Your options are A. A homestead life estate, B. The elective share, C. A reversion, D. Community property. What's your answer? Commit to one before I continue. The correct answer is B. The elective share. B is correct because Pennsylvania replaced dower and courtesy with a statutory elective share, letting a surviving spouse choose a fixed fraction of the deceased spouse's estate instead of what the will provides. The Pennsylvania elective share is 1/3. A is wrong because a homestead life estate shields the family home from certain creditors in some states. Pennsylvania does not provide that protection. Its homestead exclusion is only a property tax reduction, not a life estate for the survivor. C is wrong because a reversion is the grantor's future interest after a life estate with no remainder man. It is a land conveyancing concept, not the statutory share a surviving spouse may elect from a deceased spouse's estate. D is wrong because community property is a marital ownership system in 9 states where spouses equally own property acquired during marriage. Pennsylvania is not a community property state, so this does not describe the surviving spouse's right. The elective share is a surviving spouse's statutory right to claim a guaranteed fraction of the deceased spouse's estate, no matter what the will says. It is a flaw the legislature sets that the testator simply cannot take away. The right is statutory and fractional. Pennsylvania fixes it at 1/3. The survivor must formally elect against the will, surrendering whatever the will offers in exchange for that statutory 1/3. Pennsylvania abolished dower and courtesy. The old common law life estates tied to land and split by gender, shame, and replace them with a single clean rule. The elective share applies to the whole estate, not just land, and belongs equally to any surviving spouse. When the spouse dies, the survivor reads the will and chooses one of 2 tracks: take what the will grants, or elect against it and claim the statutory 1/3. Once the election is filed, within the statutory deadline, The will's terms no longer govern that share. The signal on any exam is a surviving spouse claiming a guaranteed portion despite what the will says. That is the elective share, Pennsylvania's modern statutory replacement for dower and courtesy, ensuring no spouse can be disinherited entirely. Question 13. A deed conveys land to a buyer with no conditions, granting the most complete ownership the law allows, lasting forever and freely inheritable. Which estate is this? Your options are A. A life estate, B. A leasehold estate, C. Fee simple absolute, D. Fee simple determinable. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Fee simple absolute. C is correct because fee simple absolute is the highest and most complete form of ownership. It is perpetual, fully inheritable, and carries the entire bundle of rights, limited only by the public and private restrictions that apply to all land. A is wrong because a life estate lasts only for the duration of a measuring life and then ends. Because it expires and cannot continue forever, it is a lesser estate than the perpetual ownership described here. B is wrong because a leasehold estate gives a tenant possession for a set time while the landlord keeps ownership. It is the estate of a renter, not the complete and perpetual ownership a fee simple absolute provides. D is wrong because fee simple determinable is ownership that ends automatically if a stated condition fails. The conveyance described carries no such condition, so the buyer receives an absolute fee rather than a defeasible one. Fee simple absolute is the most complete form of real property ownership the law recognizes. It represents total, permanent, unconditional ownership, the ceiling against which every lesser estate is measured. Two features define this estate. First, unlimited duration. The estate never ends. It simply passes from owner to owner across generations. Second, absence of conditions. No clause in the deed can trigger a loss of title. And because it is fully transferable, the owner needs no one's permission to sell, gift, or mortgage the property. Every smaller estate is defined by what it lacks compared to fee simple absolute. A defeasible fee carries a condition that can end ownership. A life estate expires at the measuring life. A leasehold conveys no ownership of the land itself. Fee simple absolute is the baseline because it lacks none of these limitations. The critical exam distinction is the word absolute. A deed granting land outright with no restrictions describes fee simple absolute. The moment a deed attaches a continuing requirement, such as land used only so long as it serves a school, the grant becomes a defeasible fee, which can be lost if that condition is broken. When an exam stem describes ownership that is total, permanent, and unconditional, the answer is fee simple absolute. If a condition appears, think defeasible fee. If duration is tied to a life, think life estate. Fee simple absolute is simply the most the law allows. Question 14. A clause requires the borrower to pay taxes and insurance into an account with the monthly payment so the lender can ensure they are paid. Which clause is this? Your options are A. The prepayment clause, B. The defeasance clause, C. The acceleration clause, D. The escrow clause. Which would you go with? Lock it in before the reveal. The correct answer is D, the escrow clause. D is correct because the escrow or impound clause requires the borrower to pay taxes and insurance into an account along with the monthly payment. This lets the lender make sure those obligations are met since unpaid taxes can take priority over the loan. A is wrong because the prepayment clause concerns whether the borrower may pay the loan off early and any penalty for doing so. It addresses an early payoff of principal, not the monthly collection of taxes and insurance from the borrower. B is wrong because the defeasance clause requires releasing the lien once the debt is fully paid. It deals with the satisfaction of the loan at the end, not the ongoing escrow of taxes and insurance throughout the loan term. C is wrong because the acceleration clause makes the entire balance due upon the borrower's default. It is a remedy for non-payment of the loan, not the mechanism by which taxes and insurance are collected with each monthly payment. When a mortgage includes an escrow clause, the borrower pays a portion of their annual property taxes and hazard insurance along with every monthly payment. The lender holds those funds in a dedicated escrow account and pays the bills when they come due. Each monthly payment bundles 4 parts: principal, interest, taxes, and insurance, often shortened to PITI. Principal and interest retire the loan debt, while the tax and insurance portions flow straight into the escrow account, where the lender manages them. The clause exists entirely to protect the lender. Unpaid property taxes can create a lien that outranks the mortgage, letting a taxing authority foreclose ahead of the lender. A lapsed insurance policy leaves the collateral exposed with no coverage. Both events directly threaten the property the loan depends on. Exam writers test whether you can match each clause to its purpose. The escrow clause handles the steady, routine prepayment of taxes and insurance during the loan's life. Acceleration, alienation, and defeasance each address very different events: default, sale, and payoff, and none of them touch taxes or insurance. Question 15. An offer states that it must be accepted by a certain date, and that date passes with no response. What has happened to the offer? Your options are: A. It has lapsed. B. It has been accepted. C. It has become an option. D. It has been assigned. Don't overthink it. Which one feels right? The correct answer is A. It has lapsed. A is correct because an offer terminates by lapse of time when it is not accepted by its stated deadline. Once that date passes without acceptance, the offer simply expires, leaving nothing for the offeree to accept afterward. B is wrong because acceptance requires a timely communicated agreement to the offer's terms. Because the deadline passed with no response, no acceptance occurred, and the offer ended rather than ripening into a contract. C is wrong because an option is a separate contract paid for that keeps an offer open for a set time. Letting an ordinary offer expire does not transform it into an option. The offer simply lapses. D is wrong because assignment is the transfer of contract rights to a third party. There is no contract to assign here, because the offer expired unaccepted, so assignment has nothing to do with the lapse. An offer doesn't stay open forever. When a deadline passes without any response from the offeree, the offer lapses automatically. No notice required, no action needed. The clock alone kills it. Once a deadline is set, the offer expires the instant that moment passes unaccepted. A late attempt to accept doesn't revive the original offer. At most, it becomes a new offer that the original offerer is free to accept or ignore. Lapse is just one of 4 ways an offer can die. It differs from revocation, where the offerer takes the offer back; rejection, where the offeree says no; and a counteroffer, where the offeree proposes different terms. The clue for lapse is always the same combination: a stated deadline, offeree silence, and the deadline simply arriving. If instead the offerer acts first or the offeree responds with different terms, that's revocation or a counteroffer, not lapse. Lapse is death by the clock. No one needs to do anything. When time runs out untouched, the offer is gone, and both parties are free to move on. Question 16. A grantor signs and acknowledges a deed, but keeps it locked in a drawer and never hands it over. Has title passed to the grantee? Your options are: A. Yes, signing a loan passes title. B. No, delivery and acceptance are required. C. Yes, acknowledgement passes title. D. Yes, once it is recorded. Got a guess? Lock it in. The correct answer is B. No, delivery and acceptance are required. B is correct because title passes only when a deed is delivered with the present intent to convey and accepted by the grantee. A signed deed never delivered conveys nothing because delivery is the moment ownership actually transfers. A is wrong because signing is a necessary element but does not by itself transfer title. Without delivery to the grantee, the executed deed remains ineffective. So the grantor's signature alone leaves ownership unchanged. C is wrong because acknowledgement before a notary confirms the signature is genuine and allows recording. It does not move title, which still requires the deed to be delivered and accepted before ownership changes hands. D is wrong because recording protects priority against third parties, but is not what transfers title. A deed locked away was never delivered, and recording cannot occur or cure the missing delivery to the grantee. A deed doesn't transfer ownership simply by being written and signed. Title passes only when two things happen. The grantor delivers the deed and the grantee accepts it. Without both, no matter how perfectly drafted or notarized, the deed transfers nothing. Execution, drafting and signing, tasaiti, only prepares the instrument. Delivery is the grantor parting with control, intending to pass title right now. Acceptance is the grantee taking it. Execution without delivery is just paperwork. Ownership doesn't move until the final two steps occur. Picture a grantor who signs a deed and locks it in a desk drawer. No title passes because there was no present intent to part with control. Contrast that with a grantor who hands the deed to the grantee intending to convey right now. That act completes the transfer, recorded or not. Delivery turns on the grantor's intent, not just physical handing over. Acceptance is usually presumed when the transfer benefits the grantee. Recording gives public notice and protects priority, but it's not what moves ownership between the parties. Delivery with present intent and acceptance do that. The classic exam clue is a grantor who signs, even notarizes, but never hands the deed over. Until delivery with present intent and acceptance both occur, the grantor still holds title. Signing prepares the instrument. Delivery and acceptance complete the conveyance. Question 17. Once a borrower fully repays the loan, which clause requires the lender to release the lien and clear the mortgage from the title? Your options are A. The acceleration clause, B. The alienation clause, C. The defeasance clause, D. The subordination clause. Which one is it? Pause the video if you need more time. The correct answer is C. The defeasance clause. C is correct because the defeasance clause requires the lender to release the lien and defeat the mortgage once the debt is fully paid. A satisfaction of mortgage is then recorded to clear the old lien from the property's public title record. A is wrong because the acceleration clause lets the lender call the balance due on default by the borrower. It deals with collecting an unpaid loan, not releasing the lien after the borrower has paid the debt in full. B is wrong because the alienation clause makes the balance due on a sale or transfer of the property. It is triggered by a conveyance to a new owner, not by full repayment that entitles the borrower to a release of the lien. D is wrong because the subordination clause changes lien priority so that a senior lien yields to a new loan. It rearranges the ranking of liens among lenders rather than releasing a lien once the loan has been fully repaid. The defeasance clause is a core mortgage provision, but it's easy to confuse with other clauses. Let's break down exactly what it does, when it fires, and why it matters for title. Once the borrower makes the final payment, the defeasance clause automatically obligates the lender to release the lien. The lender records a satisfaction of mortgage in public records. Removing the encumbrance and returning clean title to the owner, no lawsuit required. Think of the lien as a cloud over the title from the moment the loan is signed. Each payment chips away at the balance, but the cloud doesn't lift automatically when the balance hits zero. The defeasance clause is the mechanism that forces the lender to officially clear that cloud the moment payoff is confirmed. Each mortgage clause speaks at a different moment. The escrow clause works monthly. The acceleration clause fires on default. The alienation clause fires on transfer. Only the defeasance clause fires on payoff. It is the one tied to the satisfying end of the loan. Defeasance is the happy ending of a mortgage. Whenever an exam stem describes a clause that forces the lender to remove the lien once the debt is fully paid, that clause is defeasance, not acceleration, not alienation, not anything to do with default or transfer. Question 18. In a mortgage, the borrower gives the mortgage and the lender receives it. Which memory aid correctly identifies who is the mortgager and who is the mortgagee? Your options are A. The longer word lends. B. The first party always pays. C. The lender signs the note. D. The or gives the E receives. Take a second. Which answer would you pick? The correct answer is D. The or gives the E receives. D is correct because the reliable aid is that the or gives and the E receives. The mortgagor is the borrower who gives the mortgage, and the mortgagee is the lender who receives it as security for the loan being made. A is wrong because the length of the word does not indicate who lends the money. The dependable rule turns on the suffix, where the or ending gives and the E ending receives, which correctly identifies borrower and lender. B is wrong because the order in which the parties are named does not determine who pays whom. The roles are fixed by the suffixes, with the mortgagor giving the mortgage and the mortgagee receiving it as the lender. C is wrong because the lender does not sign the note. The borrower signs the note promising to repay the debt. This statement misstates the roles. While the or and D suffixes reliably identify the borrower and the lender. In mortgage law, the labels mortgagor and mortgagee trip up almost everyone at first. The key is understanding that these names follow the security instrument, not the flow of money. Every paired legal term follows a single rule. The party with the or ending is the giver, and the party with the E ending is the receiver. The borrower creates and delivers the mortgage document as a pledge, making the borrower the mortgagor. The lender receives that pledge, making the lender the mortgagee. At closing, the borrower signs and hands over a mortgage document pledging the home as collateral. That act of giving is what earns the borrower the mortgagor label. The bank's act of handing over cash does not make the bank the mortgagor. The label tracks the security instrument, not the money. The same giver-receiver logic runs through the entire family of real estate pairs. Grantor and grantee, lessor and lessee, offerer and offeree. Every pair obeys the identical rule. Learn the suffix once, and dozens of vocabulary terms sort themselves out automatically. Whenever an exam asks who is the mortgagor, ask who gives the mortgage. That is always the borrower. Hold the suffix rule firmly, and no flow of money, however large, can tempt you into reversing the labels. Question 19. Which element of a valid contract requires that something of legal value be bargained for and exchanged by each party? Your options are A. Consideration. B. Legal purpose. C. Mutual assent. D. Capacity. Before I reveal it, which one do you think is right? The correct answer is A. Consideration. A is correct because consideration is the element requiring something of legal value, bargained for and exchanged by each party. It may be money, a promise, an act or forbearance, and a bare promise to make a gift lacks it. B is wrong because legal purpose requires that the contract's object be lawful and not against public policy. It governs what the parties agree to do, not whether each party gives something of value in exchange for the other's promise. C is wrong because mutual assent is the meeting of the minds shown by offer and acceptance. It concerns whether the parties agreed at all, not the separate requirement that value be exchanged to support the agreement. D is wrong because capacity requires that the parties be of legal age and sound mind. It addresses who may contract, not the requirement that each side give legally sufficient value in the bargain. Consideration is the element that transforms a one-sided promise into a legally binding, two-sided deal. It is the price of the bargain, what each party gives and receives to make the agreement enforceable. Consideration can take four forms: money, a promise, an act, or forbearance, which means agreeing not to do something you had a legal right to do. The key is that both sides give and both sides receive. In a home sale, the buyer's promise to pay and the seller's promise to convey the deed are each the consideration for the other. Value flows both directions. A bare gift promise with nothing given in return lacks consideration and is generally unenforceable. Three things that do not satisfy consideration: past acts already completed, a promise to do what you're already legally required to do, and an unequal or unfair price. The law asks only whether real value moved both ways, not whether the deal was a good one. Consideration is one of four elements every valid contract requires. Offer and acceptance create mutual assent. Legal capacity ensures the parties are competent. A lawful object ensures the purpose is legal. Consideration confirms that each side gave value in a bargained for exchange, distinguishing real deals from casual promises. Question 20. An appraiser estimates the cost to build a structure of equivalent utility using current materials and design, rather than an exact replica. Which cost concept is this? Your options are: A. Reproduction cost, B. Replacement cost, C. Salvage cost, D. Original cost. What's your answer? Commit to one before I continue. The correct answer is B. Replacement cost. B is correct because replacement cost is the cost to build a structure of equivalent utility using current materials, design, and standards. It is more common than reproducing an exact replica because rebuilding obsolete features rarely makes economic sense for an owner. A is wrong because reproduction cost is the cost to build an exact replica using the same design and materials, including outdated features. Because the question specifies equivalent utility using current standards, the concept described is replacement rather than reproduction cost. C is wrong because salvage cost reflects the value of the components or a forced sale price at the end of useful life. It concerns disposal value, not the current cost to construct a building of equivalent utility on the site. D is wrong because original cost is what the property actually cost at the time it was first built. It is a historical figure tied to the past, not today's outlay to build an equivalent substitute as the cost approach requires. In the cost approach to value, an appraiser needs a figure for what it would cost to build the improvement new. That figure comes in two flavors, and knowing which is a classic exam trap. Replacement cost is the price to build a structure of equivalent utility using current materials, methods, and design. The focus is on delivering the same usefulness, not on duplicating the original craftsmanship detail for detail. Think of an older home with handcrafted trim and thick masonry walls. An appraiser using replacement cost doesn't price out matching that vanished craftsmanship. Instead, they estimate the cost of a modern structure the same size and usefulness, standard drywall, typical finishes, same function. Replacement cost and reproduction cost are close cousins. Replacement prices a building of equal utility with today's materials. while reproduction prices a faithful copy that matches the original materials and period details precisely. Both feed the same formula, cost new minus depreciation plus land value. On the exam, look for the signal words: equivalent utility, current materials, and not an exact replica point to replacement cost. Exact duplicate and original materials and design point to reproduction cost. Replacement cost is the practical default. It values function, not nostalgia. Question 21. A program guarantees loans to eligible veterans, requires no down payment with full entitlement, and charges a funding fee instead of monthly mortgage insurance. Which is it? Your options are A, an FHA loan, B, a conventional loan, C, a VA loan, D, a USDA loan. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C, a VA loan. C is correct because a VA loan guarantees a portion of loans to eligible veterans and service members, requires no down payment with full entitlement, and charges a one-time funding fee rather than monthly mortgage insurance. Service-disabled veterans are exempt from that fee. A is wrong because an FHA loan is insured, requires a 3.5% down payment, and charges a mortgage insurance premium. It is open to general borrowers and is not defined by veteran eligibility or a funding fee instead of insurance. B is wrong because a conventional loan has no government backing and requires private mortgage insurance above 80% loan to value. It is not a veterans program and does not substitute a funding fee for monthly mortgage insurance. D is wrong because a USDA loan serves buyers in eligible rural areas with an income limit and a guarantee fee. Its eligibility is geographic and income-based, rather than tied to military service with full entitlement, so it does not match. A VA loan is a mortgage issued by a private lender but guaranteed by the Federal Department of Veterans Affairs. It exists as a benefit earned through military service, designed to help veterans, active duty members, and certain surviving spouses become homeowners on favorable terms. The government does not lend the money directly. Instead, the VA stands behind a portion of the loan, promising to reimburse the lender if the borrower defaults. That guarantee removes the lender's main risk and allows them to offer terms a civilian borrower could rarely receive. 3 features define this program. First, borrowers with full entitlement can finance the entire purchase price with no down payment. Second, instead of recurring monthly mortgage insurance, borrowers pay a single one-time funding fee, keeping monthly payments lower. Third, eligibility is tied to military service and confirmed by a certificate. The last in contrast lines up 3 major loan types. A conventional loan is not government-backed and typically requires a down payment or private mortgage insurance. The FHA loan is government insured and open to the public, requiring a modest down payment plus ongoing mortgage insurance premiums. Only the VA loan is government guaranteed, limited to those with military service, and uniquely allows nothing down with just a funding fee. Whenever an exam describes a loan reserved for those who served, financed with nothing down and a one-time funding fee, that program is always the VA loan. If it mentions low down payment loans open to the general public with ongoing mortgage insurance, that is the FHA loan instead. Question 22. A principal accepts the benefit of an act an agent performed without prior authority, thereby proving it after the fact. How was this agency created? Your options are A, by estoppel, B, by express agreement, C, by an option, D, by ratification. Which would you go with? Lock it in before the reveal. The correct answer is D, by ratification. D is correct because ratification creates agency after the fact. when a principal accepts the benefit of an act the agent performed without prior authority. By approving the unauthorized act retroactively, the principal adopts it as if it had been authorized. A is wrong because estoppel arises when a principal's words or conduct lead a third party to reasonably believe someone is the agent, barring the principal from denying it. Here the principal approved an act afterward, which is ratification, not estoppel. B is wrong because express agreement creates agency by a stated contract, such as a listing. The agency here arose from approving an unauthorized act later, not from a contract formed in advance, so it is ratification. C is wrong because an option is a contract to keep an offer open and has nothing to do with creating agency. The retroactive approval of an unauthorized act is ratification, not the exercise of an option. Ratification is a unique way an agency relationship can form, not before an agent acts, but after. Unlike express or implied authority, ratification works backward, validating something that was done without any permission at all. Here, an agent acts first, without permission, and the principal later embraces the results. That after-the-fact endorsement reaches back and treats the original act as though it had been authorized from the very beginning. For ratification to work, the principal must know the material facts and then choose to approve, expressly or by conduct. Crucially, the principal cannot cherry-pick. Adopting the act means adopting all of it, and the principal must have been capable of granting authority at the time the act was performed. It helps to contrast all four sources of agency. Express and implied authority both exist before the agent acts. Estoppel bins a principal who carelessly allowed a false impression of authority. Ratification alone operates backward. It is the only method that validates an act already taken without authority. Whenever a fact pattern shows a principal who gave no prior authority but later accepts the benefit of an unauthorized act, the answer is ratification. The agent acted first, the principal adopted it after, and the law treats the authority as if it existed all along. Question 23. Under Pennsylvania law, when must a licensee provide the consumer notice explaining the available agency relationships? Your options are A. At the initial interview, B. At the closing table, C. After an offer is accepted, D. Only if the consumer asks. Don't overthink it. Which one feels right? The correct answer is A. At the initial interview. A is correct because Pennsylvania requires the consumer notice at the initial interview, the first substantive contact, before the consumer shares confidential information. It explains the available relationships and duties, and prominently states that it is not a contract. B is wrong because providing the notice at closing comes far too late to inform the consumer's early choices. Pennsylvania requires it at the initial interview, before confidences are shared, so the consumer understands the relationships from the start. C is wrong because waiting until after an offer is accepted defeats the notice's purpose. The consumer notice must come at first substantive contact, well before negotiations, so the consumer knows whom the licensee may represent. D is wrong because the duty to deliver the consumer notice does not depend on the consumer requesting it. The licensee must provide it at the initial interview as a matter of law, whether or not the consumer asks. In Pennsylvania, real estate licensees must deliver the consumer notice at the very start of any meaningful interaction. This isn't just procedural. It's designed to protect consumers before they inadvertently share information that could work against them. The consumer notice lays out the agency relationships a licensee can hold and the duties attached to each. Its power comes entirely from its timing, delivered before any meaningful discussion, so the consumer understands the situation before anything confidential is said. Picture a buyer sitting down with a salesperson for the first time. Before the conversation about homes or price ranges goes any further, the salesperson presents the consumer notice. That single handoff at the initial interview is exactly what Pennsylvania law requires. It helps to contrast the consumer notice with other familiar paperwork. Listing and buyer agency agreements create representation and come when the consumer commits. Closing documents transfer the property at the end. The consumer notice stands apart by arriving first, Milat, before any of those relationships or transactions exist. On any exam question about when a Pennsylvania licensee delivers the consumer notice, the answer is the initial interview, the moment substantive discussion begins. Any later milestone, like an offer, a listing, or closing, describes a different document entirely. Question 24. A lender may not deny credit based on race, religion, sex, marital status, age, or because an applicant receives public assistance. Which law forbids this? Your options are A. The Truth in Lending Act, B. The Equal Credit Opportunity Act, C. The Settlement Procedures Act, D. The Equity Protection Act. Got a guess? Lock it in. The correct answer is B. The Equal Credit Opportunity Act. B is correct because the Equal Credit Opportunity Act prohibits discrimination in the extension of credit based on race, color, religion, national origin, sex, marital status, age, or receipt of public assistance. It is the lending counterpart to the fair housing laws. A is wrong because the Truth in Lending Act requires disclosure of the cost of credit, such as the annual percentage rate and finance charge. It governs how loan terms are disclosed to borrowers, not discrimination, in deciding whether to grant credit. C is wrong because the Settlement Procedures Act regulates the closing process and bans kickbacks for settlement service referrals. It addresses settlement practices and disclosures, not discrimination among applicants seeking to obtain credit. D is wrong because the Equity Protection Act imposes extra protections on high-cost mortgages with abusive terms. It targets predatory loan features, not unlawful discrimination against credit applicants based on their protected characteristics. The Equal Credit Opportunity Act is a federal law that forces lenders to judge applicants on financial merit alone. It exists because history showed creditworthy borrowers being turned away for reasons that had nothing to do with their ability to repay. The law lists specific prohibited bases. A lender cannot use an applicant's race, color, religion, or national origin, their sex or marital status, their age, or the fact that part of their income comes from a public assistance program. The law applies at every stage of the credit process. Lenders must evaluate applications using legitimate financial factors, things like credit history and debt-to-income ratio, and must ignore the prohibited characteristics entirely. The critical exam distinction is ECO versus the Fair Housing Act. ECOA governs access to credit and applies to lenders. The Fair Housing Act governs the sale and rental of housing. When the discrimination strikes a credit application, ECOA is the law that speaks. On request, a rejected applicant is entitled to the specific reasons for denial, a right that lets borrowers detect and challenge any improper use of a prohibited basis. Spot a lender, an applicant, and a denial tied to a protected characteristic. And the answer is the Equal Credit Opportunity Act. Question 25. Two parties make an agreement whose object is itself unlawful and against public policy. What is the legal effect of that agreement? Your options are A. It is voidable, B. It is enforceable with consent, C. It is void, D. It is unenforceable but valid. Which one is it? Pause the video if you need more time. The correct answer is C. It is void. C is correct because an agreement with an illegal purpose is void and unenforceable, having no legal effect at all. Because a lawful object is an essential element of a valid contract, no careful drafting can make an unlawful agreement enforceable. A is wrong, because a voidable contract is valid but may be disaffirmed by a protected party, such as a minor or a defrauded buyer. An illegal agreement is worse than voidable. It never had any legal effect because its purpose was unlawful. B is wrong because consent cannot rescue an agreement to do something illegal. The parties may both want to proceed, but the law refuses to enforce an unlawful purpose, so their agreement is void regardless of any consent. D is wrong because an unenforceable but valid contract is a genuine agreement the court simply will not enforce, like an oral land contract. An illegal agreement is void from the start, never reaching the status of a valid contract. When the object of an agreement is unlawful or against public policy, the law treats that agreement as if it never existed at all. This is not a weak or risky contract. It is a legal nullity, incapable of creating any rights or obligations from the very beginning. The mechanism turns entirely on the object of the agreement. If what the parties are trying to accomplish is illegal or against public policy, the agreement is void on its face. No signature, no later approval, and no intent to be bound can breathe legal life into an unlawful object. Courts will not lend their power to enforce illegal aims. If a court enforced a bargain built on an unlawful purpose, it would be helping accomplish the very thing the law forbids. So the court steps back entirely, leaving both parties exactly where it finds them. These four categories form a spectrum of enforceability. A valid contract binds both sides fully. A voidable contract, triggered by fraud, duress, or a minor's involvement, is valid until the affected party chooses to undo it. An unenforceable contract exists but cannot be sued upon. A void agreement sits at the far end with no legal force at all. On an exam, the clue words are unlawful object, illegal purpose, and against public policy, all pointing to void. If the stem describes fraud, duress, or a minor, think voidable instead. The key distinction is that a void agreement was never valid, while a voidable one is valid until someone chooses to escape it. Question 20x. A person who has been adjudicated legally incompetent by a court signs a contract to sell land. What is the legal effect of that contract? Your options are: A. It is valid and binding. B. It is voidable by the buyer. C. It is merely unenforceable. D. It is void. Take a second. Which answer would you pick? The correct answer is D. It is void. D is correct because a contract made by a person who has been adjudicated legally incompetent is void, having no legal effect at all. Such a person can contract only through a guardian or with court approval, so the agreement cannot bind anyone. Is wrong because a valid contract requires competent parties, which an adjudicated incompetent person lacks, because capacity is missing from the outset. The agreement cannot be fully binding, so calling it valid misstates its legal effect. B is wrong because a voidable contract is one a protected party may disaffirm. As with a minor or a merely impaired signer, a court adjudication of incompetence goes further, rendering the contract void rather than merely voidable. C is wrong because an unenforceable contract is valid but barred from court enforcement, such as an oral land contract. Here, the defect is a lack of capacity at formation, which makes the agreement void, not simply unenforceable. When capacity problems appear on an exam, the key dividing line is whether a court has already formally ruled on the person's mental competence. That single fact determines whether a contract is merely voidable or completely void. Adjudication means a court has formally stripped the person of their legal capacity to contract. A guardian is appointed to act on their behalf. and from that moment forward, any agreement the ward signs is a legal nullity. Void from the outset, not merely voidable. Because the court's judgment exists before the signing, the law has already removed the ward's power to consent. Only the guardian, acting with proper authority, can create a binding agreement on the ward's behalf. The contrast is straightforward once you know the rule. A person adjudicated incompetent produces a void contract. No enforcement is possible. A mentally impaired person who was never adjudicated, and a minor, each produce only a voidable contract that can be honored or escaped depending on circumstances. When an exam stem mentions adjudicated incompetent, declared incompetent by a court, or under guardianship, the answer is always void. The court's prior judgment is the dividing line that removes any contractual power before the pen ever touches the paper. Question 27. The Federal Fair Housing Act prohibits housing discrimination based on a person's membership in protected classes. How many protected classes does the Federal Act list? Your options are A7, B5, C10, D3. Before I reveal it, which one do you think is right? The correct answer is A, 7. A is correct because the Federal Fair Housing Act lists 7 protected classes: race, color, religion, national origin, sex, familial status, and disability. State and local laws frequently add more classes, and a licensee must obey the strictest applicable law. B is wrong because 5 understates the federal list of protected classes. The Fair Housing Act protects 7 classes, including familial status and disability that were added by later amendments. So the count is more than 5. C is wrong because 10 overstates the federal count of protected classes. While some state and local laws add classes beyond the federal list, the Federal Fair Housing Act itself protects 7 classes, not 10. D is wrong because 3 is far too few to describe the federal protected classes. The Act began with several classes and was expanded over time to a total of 7, so 3 does not capture the full list. The Federal Fair Housing Act is one of the most tested topics in real estate licensing exams. At its core, the Act protects specific groups of people from discrimination in the sale, rental, and financing of housing. Understanding exactly which groups are covered and how many of who is essential. The Federal Act names exactly 7 protected classes: race, color, religion, national origin, sex, familial status, and disability. The 7 define the federal floor, the baseline that every jurisdiction in the country must honor. Memorize this list and the count. Familial status is one of the most commonly tested classes. It protects households with children under 18 and pregnant individuals. A landlord who turns away a family simply because they have young children is violating the Fair Housing Act, just as they would be if they discriminated based on race, religion, or any of the other 6 classes. The federal 7 are a floor, not a ceiling. States like Pennsylvania and local governments can add protected classes, such as age or source of income, on top of the federal list. When an exam question asks specifically about the Federal Fair Housing Act, the answer is always 7 classes. Watch for stems that introduce age or income and tie them to state law rather than the Federal Act. Question 28. Parties agree to substitute a new contract for an old one, releasing the original party from the prior obligation. What is this called? Your options are A. Assignment, B. Novation, C. Rescission, D. Ratification. What's your answer? Commit to one before I continue. The correct answer is B. Novation. B is correct because novation substitutes a new contract or a new party for an original one. With the original party released from the obligation, it differs from assignment where the original party usually remains secondarily liable on the contract. A is wrong because assignment transfers a party's rights under a contract to a third party, but the assigner often remains secondarily liable. Because novation releases the original party, the two differ on whether the original party stays on the hook. C is wrong because rescission cancels a contract and returns the parties to their pre-contract positions. It unwinds an agreement rather than replacing it with a new one that releases an original party, which is what novation does. D is wrong because ratification approves an unauthorized act after the fact, adopting it retroactively. It validates earlier conduct rather than substituting a new contract or party, so it does not describe a release through novation. Novation is the legal mechanism that fully substitutes a new contract or a new party for an existing one, releasing the original party from all further liability. The defining feature is not the substitution itself, but the release that comes with it. Novation has 4 required elements: a valid prior obligation, the agreement of all parties, extinguishment of the old contract, and a valid new contract replacing it. Consent of every party is essential. No one can be released or bound without agreeing. Picture a landlord, a departing tenant, and an incoming company all signing a new lease together. The old lease is extinguished entirely. The original tenant is released, and the new tenant steps in as the sole obliger bound to the landlord. This is the contrast exam writer's test. In novation, all parties consent. The original obliger is fully released and the old contract is gone. In assignment, rights transfer to someone new, but the original party often remains secondarily liable if the new one fails to perform. Whenever an exam stem describes parties agreeing to swap in a new obliger and expressly free the original from any further duty, that is novation. The clue is always the release. If the original party walks away clean, assignment cannot be the answer. Question 29. A buyer offers a price. The seller responds with a higher one, and the buyer then tries to accept the original lower price. Can the buyer still do so? Your options are A. Yes, the original offer stands. B. Yes, if within 3 days. C. No, the counteroffer rejected it. D. Only with the broker's consent. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. No, the counteroffer rejected it. C is correct because a counteroffer rejects the original offer and replaces it with a new one. Once the seller countered at a higher price, the buyer's original offer no longer existed to accept, so the buyer cannot revive the lower price. A is wrong because the original offer does not survive a counteroffer. By responding with a higher price, the seller rejected and extinguished the buyer's first offer, so there is nothing left at the lower price for the buyer to accept. B is wrong because no time window lets a buyer reach back to a rejected offer. A counteroffer terminates the prior offer immediately, so the lower price is gone regardless of how soon the buyer tries to accept it. D is wrong because the broker's consent has nothing to do with the offer's survival. A counteroffer is a legal rejection of the prior offer, and no consent can resurrect an offer the seller already replaced with a new one. When one party responds to an offer by proposing different terms, that response is a counteroffer, and a counteroffer does something powerful. It destroys the original offer entirely. Understanding why requires looking at what a counteroffer actually does under contract law. A counteroffer simultaneously rejects the original offer and creates a new one. This flips the roles. The original offeror now holds the power to accept or reject. The original offer is gone the moment the counter is made. It cannot be revived. Picture a buyer offering $200,000 for a home. The seller counters at $220,000. That counter kills the buyer's original price. It is struck from the table. The seller's figure is now the live offer, and the buyer must respond to that, not to what they originally proposed. It helps to contrast all four ways an offer can end. Acceptance on identical terms forms a contract. Rejection ends the offer with nothing replacing it. Lapse ends it through the passage of time. A counteroffer is unique. What? It both rejects the original and simultaneously proposes new terms, which is why the first offer can never be accepted afterward. On an exam, the signal is a party countering and then reaching back to accept the original terms. That late acceptance forms no contract. The counteroffer already rejected the original. The only way those first terms return is if the other side voluntarily offers them again. Question 30. A contract states that time is of the essence and a party performs 1 day after the stated deadline. What is the consequence? Your options are: A. There is a brief grace period. B. The deadline is only a suggestion. C. The contract becomes void. D. Late performance is a breach. Which would you go with? Lock it in before the reveal. The correct answer is D. Late performance is a breach. D is correct because when a contract states time is of the essence, the deadlines are material with no grace period. A party who fails to perform by the stated date is in breach, which is why missing a contingency deadline matters. A is wrong because a time is of the essence clause is meant to eliminate any grace period. The stated dates become strict, so a party cannot rely on extra time to perform after the deadline has already passed. B is wrong because the clause makes the deadlines binding rather than advisory. Treating a stated date as a mere suggestion defeats the very purpose of the clause, which is to make timely performance essential to the bargain. C is wrong because missing a deadline under this clause is a breach, but it does not render the contract void from the start. The non-breaching party gains remedies for the breach rather than the contract having no effect at all. A time is of the essence clause transforms ordinary contract deadlines into strict, unforgiving cutoffs. Understanding why this clause exists and what it does mechanically is essential for any real estate transaction. Ordinarily, courts may excuse a short, harmless delay as immaterial. This clause removes that cushion entirely, declaring that every listed date is a material term. Lateness alone constitutes breach. The non-breaching party does not have to show the delay caused any real damage. Strict deadlines matter when the entire deal is built around a specific date. A buyer's mortgage rate lock, a seller who must close to fund another purchase, or a transaction tied to a tax deadline. All of these depend on dates holding firm to the letter. Without the clause, a court might treat a brief delay as immaterial and excuse it. With the clause, the calendar is rigid. 1 day late is a breach, and the other party may cancel the contract, retain a deposit, or pursue damages without needing to prove any harm was caused. Time is of the essence is the switch that converts a flexible deadline into a hard one. On any exam, if the contract contains that clause and a party performs even 1 day late, the answer is breach, no matter how small the delay or how little damage resulted. Question 31. A licensee learns that a basement has recurring mold growth. What is the underlying source that must be corrected to remedy it? Your options are: A. Excess moisture. B. Old paint. C. Poor lighting. D. Lead pipes. Don't overthink it. Which one feels right? The correct answer is A. Excess moisture. A is correct because mold results from moisture intrusion and high humidity. So the cure is to find and fix the water source and then remediate the affected materials. Known mold and water intrusion problems are part of property condition disclosure. B is wrong because old paint does not cause mold to grow on a surface. Mold needs moisture and organic material, so eliminating the water source, not addressing the paint, is what actually remedies a recurring mold problem. C is wrong because poor lighting plays no role in producing mold inside a basement. The growth depends on moisture and humidity, so correcting the water intrusion is the remedy rather than improving the room's lighting. D is wrong because lead pipes are a drinking water contamination concern, not a cause of mold growth. Because mold arises from moisture, fixing the leak or humidity source is the response, which is unrelated to the plumbing material. When mold keeps returning in a building, it's telling you something important. The real problem isn't the mold itself, it's the moisture feeding it. Understanding this distinction changes everything about how you approach remediation. Mold is a living organism that needs three things to colonize a surface: moisture, a food source like drywall or wood, and time. Of these, moisture is the only factor a property owner can realistically control. Moisture can enter a building through a leaking pipe, a cracked foundation, poor exterior drainage, or condensation on cold surfaces. Until that specific source is sealed, dried, or ventilated, no amount of scrubbing the mold will produce a lasting result. Effective remediation always follows the correct sequence. First, find and stop the water. Then remove the damaged materials, dry the area completely, and replace what was lost. Skipping straight to cleaning without stopping the moisture guarantees the mold will return. Mold, mildew, wood rot, and musty odors are all downstream effects of one upstream problem: water where it doesn't belong. On the exam and in practice, when a STEM asks for the underlying source that must be corrected, the answer traces back to excess moisture every time. Question 32. The Pennsylvania Consumer Notice prominently states a key fact about its own legal effect. What does it declare itself to be? Your options are A. A binding listing agreement. B. Not a contract. C. An offer to purchase. D. A dual agency consent. Got a guess? Lock it in. The correct answer is B. Not a contract. B is correct because the consumer notice prominently states that it is not a contract. It is informational, explaining the relationships a consumer may have with a broker, and it does not by itself create any agency relationship between them. A is wrong because the consumer notice is not a listing agreement and creates no representation. A listing is a separate written contract. The notice merely informs the consumer about the available relationships and their duties. C is wrong because the notice is not an offer to purchase anything. It is a disclosure given at first contact to explain agency options, not a contract proposing to buy or sell property. D is wrong because the notice is not a dual agency consent form. Consent to dual agency is a separate written agreement. The consumer notice simply describes the relationships and states that it is not a contract. The Pennsylvania Consumer Notice carries a built-in declaration about its own legal character. Understanding what that declaration means and why it exists is the core idea behind this rule. The notice is purely informational. It lays out the agency relationships a licensee can have and the duties that come with each. When a consumer signs the acknowledgement line, that signature confirms only that the document was received and reviewed, nothing more. The notice and an agency agreement are two distinct documents serving two distinct purposes. The notice comes first and informs. The agency agreement comes later and commits. Only the agreement actually creates representation and obligates the parties. The self-declaration prevents a dangerous misunderstanding. A consumer receiving a formal document might assume signing it locks them into a working relationship. By announcing its own limited legal effect, the notice ensures the educating document is never mistaken for the committing one. Whenever an exam question asks what the consumer notice says about its own legal effect, The answer is that it declares itself not a contract. Representation only begins when the consumer later signs a separate listing or buyer agency agreement, deliberately and knowingly. Question 33. A real estate office is open to the public. Under which law must it remove architectural barriers where readily achievable and meet accessibility standards? Your options are A. The Sherman Antitrust Act, B. The Statute of Frauds, C. The Americans with Disabilities Act, D. The Clean Water Act. Which one is it? Pause the video if you need more time. The correct answer is C. The Americans with Disability Act. C is correct because the Americans with Disability Act governs public accommodations. A real estate office open to the public must remove architectural barriers where readily achievable, and new construction and alterations must meet the accessibility design standards. A is wrong because the Sherman Antitrust Act prohibits agreements that restrain trade, such as price fixing among competitors. It has nothing to do with making a public office accessible, which is governed by the Americans with Disabilities Act. B is wrong because the Statute of Frauds requires certain contracts to be in writing to be enforceable. It concerns contract enforceability, not the accessibility of a public accommodation, which falls under the Americans with Disabilities Act. D is wrong because the Clean Water Act regulates discharges of pollutants into the nation's waters. It is an environmental statute unrelated to barrier removal at a public office, which that accessibility law requires. The Americans with Disabilities Act is a federal civil rights law that treats access to public accommodations as a fundamental right. It exists because physical barriers long excluded people with disabilities from everyday commercial life. The ADA imposes layered duties depending on the situation. For existing buildings, it requires barrier removal that is readily achievable, meaning accomplishable without undue difficulty or expense. For new construction and major alterations, stricter standards apply in full, since building access in from the start costs far less than retrofitting later. Picture a real estate brokerage on a commercial street. A wheelchair user cannot enter because a step blocks the door, and the counter is too high. Under the ADA, the business must install a ramp and lower the counter where readily achievable, because accessibility is not optional for a public accommodation. The critical distinction on any exam is setting. The ADA governs commercial facilities and public accommodations, offices, stores, services open to the public. The Fair Housing Act governs dwellings requiring reasonable accommodations for disabled residents. A real estate office serving walk-in clients is a public accommodation, so its accessibility duty flows from the ADA, not the Fair Housing Act. When an exam stem mentions a business open to the public, architectural barriers, readily achievable removal, or accessibility standards, the law is the Americans with Disabilities Act. If it describes a landlord and a tenant's dwelling, think Fair Housing Act instead. Question 34. Which Pennsylvania body enforces the Pennsylvania Human Relations Act and receives housing discrimination complaints? Your options are A. The State Real Estate Commission, B. The Recorder of Deeds, C. The Department of Environmental Protection, D. The Human Relations Commission. Take a second. Which answer would you pick? The correct answer is D. The Human Relations Commission. D is correct because the Pennsylvania Human Relations Commission enforces the Human Relations Act and receives housing discrimination complaints, generally filed within 180 days. It bars the same practices as federal law while reaching additional protected classes. A is wrong because the State Real Estate Commission licenses and disciplines real estate licensees in the Commonwealth. Housing discrimination complaints under the Human Relations Act go to the Human Relations Commission. not to the licensing board. B is wrong because the recorder of deeds maintains the county land records and records deeds and mortgages. It plays no role in enforcing fair housing, which is the function of the Pennsylvania Human Relations Commission instead. C is wrong because the Department of Environmental Protection handles environmental matters such as cleanup and storage tanks. Fair housing complaints are enforced by the Pennsylvania Human Relations Commission, not by an environmental agency. Pennsylvania created a dedicated state agency to enforce its anti-discrimination law, the Pennsylvania Human Relations Commission. This body exists because a statute forbidding discrimination means little without someone empowered to investigate and remedy it. When someone believes they were denied housing, employment, or a public accommodation because of a protected characteristic, they file a complaint with the Commission. It investigates, attempts conciliation, and if that fails, can hold a public hearing and order relief, such as providing housing or paying damages. The process moves from intake to resolution. A complaint is filed. The Commission investigates for probable cause, attempts conciliation, and if unresolved, proceeds to a hearing where it can order the landlord or employer to make things right. The most common exam trap is confusing Pennsylvania's two commissions. The Human Relations Commission enforces the Human Relations Act and handles discrimination. The State Real Estate Commission enforces license law and disciplines licensees. Both hold hearing, but their subjects are completely different. Whenever an exam stem mentions the Pennsylvania Human Relations Act, enforcing anti-discrimination law, or receiving housing complaints, the answer is the Human Relations Commission, not a federal agency, and not the Real Estate Commission. Question 35. A Phase 1 assessment flags a recognized environmental condition at a former gas station. What is the next step to confirm contamination? Your options are A. A Phase 2 assessment with sampling. B. Immediate cleanup. C. A title search. D. Filing for a variance. Before I reveal it, which one do you think is right? The correct answer is A. A Phase 2 assessment with sampling. A is correct because when a Phase 1 assessment raises concerns, the next step is a Phase 2 assessment, which involves physical sampling and laboratory testing of soil, water, and materials to confirm and measure any contamination that is present. B is wrong because immediate cleanup, the remediation stage, comes only after contamination has been confirmed and measured. The step that follows a concerning Phase 1 is sampling and testing, not jumping directly to the costly cleanup phase. C is wrong because a title search examines ownership records for liens and defects in title. It addresses legal ownership, not whether soil and groundwater are contaminated, which requires a Phase 2 sampling and testing assessment. D is wrong because filing for a variance seeks relief from a local zoning rule for a parcel. It is unrelated to confirming contamination, which is established through Phase 2 sampling and laboratory analysis rather than a zoning request. Environmental site assessments follow a deliberate two-phase structure designed to match investigative effort to actual risk. Understanding what each phase does and why they're separate is the key concept here. The process moves in 3 stages. Phase 1 reviews records and conducts a visual inspection without disturbing the ground. Phase 2 collects physical samples and tests them in a lab. Remediation only begins after contamination is confirmed. Each stage is triggered by the findings of the one before it. A Phase 2 is triggered specifically when Phase 1 identifies a recognized environmental condition, a red flag suggesting contamination may exist. A former gas station with buried underground fuel tanks is a classic example. At that point, records and visual inspection are no longer enough and physical sampling becomes necessary. Environmental consultants design a sampling plan targeting the specific concern Phase 1 identified. They drill borings and install monitoring wells near suspect locations, like where old fuel tanks sat, then send collected samples to a laboratory. Results reveal whether contaminants are present, at what concentrations, and how far they've spread. The recognized environmental conditions surfaced in Phase 1 is always the trigger that sends the process into Phase 2. Phase 2 turns suspicion into measurable fact, and only confirmed contamination leads to remediation. Question 36. A Pennsylvania landlord refuses to rent to a 55-year-old applicant solely because of age. Is this lawful? Your options are A. Yes, age is unprotected. B. No, the Human Relations Act protects age. C. Yes, under federal law. D. Only if disclosed in writing. What's your answer? Commit to one before I continue. The correct answer is B. No, the Human Relations Act protects age. B is correct because although age is not a federal fair housing protected class, the Pennsylvania Human Relations Act protects age, meaning 40 or older. Refusing the applicant solely because of age violates the act, so the refusal is unlawful in Pennsylvania. A is wrong because age is not unprotected in Pennsylvania, even though federal law omits it. The Human Relations Act protects persons 40 or older, so refusing this applicant solely because of age is unlawful under state law. C is wrong because federal law does not authorize age discrimination. It simply does not list age as a protected class. Pennsylvania law does protect age, so the refusal violates the Human Relations Act regardless of the federal silence. D is wrong because disclosing the discrimination in writing does not make it lawful at all. Refusing to rent because of age violates the Pennsylvania Human Relations Act whether or not the discriminatory reason is written down. The Federal Fair Housing Act sets a nationwide minimum, but states can go further. Pennsylvania did exactly that by adding age as a protected class in housing, something the federal law does not cover. The Federal Fair Housing Act protects 7 classes, including race, religion, national origin, sex, and familial status. Pennsylvania's Human Relations Act covers all of those and adds age, protecting anyone 40 or older from housing discrimination. Think of state law as a second shield placed on top of the federal one. Where federal law leaves a gap, such as age, Pennsylvania steps in. A landlord in Pennsylvania who refuses to rent to a qualified applicant solely because they are 40 or older is acting unlawfully under state law. Even if federal law alone would not reach that refusal. When discrimination occurs in Pennsylvania, both laws may apply. If the basis is one of the federal 7, both federal and state law respond. If the basis is age, only Pennsylvania's Human Relations Act applies, and the aggrieved person pursues a remedy through the state system. The key exam insight is this: never assume the federal 7 classes are the whole story. In Pennsylvania, age is expressly protected in housing. A refusal the federal statute might permit can still be unlawful within the state. Question 37. Real estate law has shifted away from caveat emptor toward requiring sellers to reveal known problems. What does this modern approach require? Your options are A. Buyers to assume all risk. B. Sellers to warrant condition forever. C. Mandatory disclosure of known defects. D. Agents to inspect personally. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Mandatory disclosure of known defects. C is correct because modern law has moved from let the buyer beware toward mandatory disclosure, requiring a seller to reveal known material defects, especially latent ones a buyer's inspection would not reveal, generally before the buyer becomes obligated. A is wrong because requiring buyers to assume all risk describes the old caveat emptor rule the law deliberately moved away from. The modern approach places an affirmative duty on the seller to disclose known material defects to the buyer. B is wrong because a disclosure statement is the seller's representation of what is known, not a perpetual warranty of condition. The duty is to reveal known defects, not to guarantee the property's condition into the indefinite future. D is wrong because the licensee is not required to personally inspect the property for defects. The disclosure duty falls on the seller to reveal known conditions, while the buyer is encouraged to obtain an independent professional inspection. Modern real estate law has fundamentally shifted how buyers and sellers share information about a property's condition. Understanding why that shift happened, and exactly where the new duty begins and ends, is the core of this concept. Under caveat emptor, the buyer purchased at their own risk, and a silent seller owed no duty to speak. The modern approach flips that. Sellers must now disclose no material defects, rather than staying quiet and letting buyers discover problems too late. In Pennsylvania and most modern states, sellers complete a property disclosure statement listing known issues with systems and components. The seller need not inspect for unknown problems, but must not conceal defects they are already aware of. The duty has clear boundaries. Sellers must disclose known material defects, those significant enough to affect value or a buyer's decision. They are not required to guarantee perfection or hunt for problems they were unaware of. The rule forbids hiding what you know, not knowing everything. When an exam stem describes the modern duty replacing buyer beware, the answer is mandatory disclosure of known material defects. If the stem describes a buyer bearing all risk with no seller duty to speak, that is the old caveat emptor rule, which the modern disclosure regime has largely displaced. Question 38. A landlord must waive a no pets policy and charge no pet fee for a tenant's assistance animal. Under disability protection, what is this kind of change called? Your options are A zoning variance, B, a steering practice, C, a nat listing, D, a reasonable accommodation. Which would you go with? Lock it in before the reveal. The correct answer is D, a reasonable accommodation. D is correct because a reasonable accommodation is a change to rules or policies that lets a person with a disability fully enjoy housing. Waiving a no pets policy for an assistance animal, which is not a pet, is a classic example. A is wrong because a zoning variance is relief from a local dimensional requirement granted by a zoning board. It is a land use concept, not the fair housing duty to adjust a no pets rule for a tenant who relies on an assistance animal. B is wrong because steering is the illegal channeling of buyers or renters by protected class into or away from areas. It is a prohibited practice, not the lawful adjustment of waiving a no pets policy for a tenant's assistance animal. C is wrong because a net listing concerns how a broker is compensated by keeping amounts above a stated net. It has nothing to do with disability accommodations, which is what waiving a no pets rule for an assistance animal represents. Under fair housing law, disabled tenants are entitled to two distinct protections: reasonable accommodations and reasonable modifications. Understanding the difference is essential because the two involve completely different kinds of changes. A reasonable accommodation adjusts how a housing provider operates. The classic example is waiving a no pets policy and charging no pet fee so a disabled tenant can keep an assistance animal, because the animal is a disability-related aid, not a pet. The provider can still hold the tenant responsible for any actual damage the animal causes. The process is straightforward. The tenant requests the accommodation, links it to a disability and a functional need, and the provider must grant it. As long as it does not impose an undue financial or administrative burden or fundamentally alter the operation. The landlord adjusts the policy, not the premises. The tenant gains equal use of the dwelling, and the building itself remains unchanged. What bends is the rule, not the structure. The critical contrast to remember: a reasonable accommodation changes rules, policies, or services, like waiving a no pets rule. A reasonable modification changes the physical space, like installing a ramp or widening a doorway. On any exam, if a policy bends for a disabled resident, that is an accommodation. If the building changes, that is a modification. Question 39. A friend negotiates the sale of a neighbor's house for a $2,000 fee without a license. Is a license required for this? Your options are: A. Yes, a license is required. B. No, friends are exempt. C. No, the fee is too small. D. Only if the sale closes. Don't overthink it. Which one feels right? The correct answer is A. Yes, a license is required. A is correct because negotiating the sale of another person's property for compensation is a regulated activity requiring a license, and doing it unlicensed is a crime. Had the friend sold their own house, no license would be needed. B is wrong because there is no exemption simply because the parties happen to be friends. Negotiating another person's sale for a fee is a regulated activity requiring a license, so the friendship does not excuse the unlicensed conduct. C is wrong because the size of the fee does not matter to the requirement. Acting for another for any compensation in a regulated activity requires a license, so a small fee does not remove the requirement or cure the violation. D is wrong because the requirement does not depend on whether the sale ultimately closes. Offering to negotiate another sale for compensation already requires a license, regardless of whether the transaction is finally completed or not. Real estate licensing law has a precise trigger. Understanding exactly what trips that trigger and what doesn't is the key to answering these questions correctly. Two ingredients must both be present. The person is acting for someone else and they are being paid for it. When both conditions are met and the activity involves negotiating, listing, selling, or leasing real estate, a license is required, no matter how casual or friendly the arrangement appears. Consider a neighbor who negotiates a home sale for someone else and pockets a $2,000 fee. That person is acting for another and receiving compensation. Both triggers are met. Contrast that with an owner selling their own home, where neither trigger applies and no license is needed. The law carves out exemptions: owners dealing with their own property, and those acting under specific legal authority like a power of attorney. But a friend who negotiates a sale on the owner's behalf and collects a fee fits none of these exemptions. The casual neighborly framing is the exam trap. Strip it away and the activity is real estate brokerage, something the law does not allow an unlicensed person to perform for pay. Question 40. An agent shows minority buyers homes only in certain neighborhoods, channeling them by protected class even while believing it is helpful. What is this practice called? Your options are: A. Blockbusting, B. Steering, C. Redlining, D. Puffing. Got a guess? Lock it in. The correct answer is B. Steering. B is correct because steering is channeling prospects toward or away from particular neighborhoods or buildings based on a protected class. It denies people free choice and is illegal even when framed as helpful, because it limits where buyers may look. A is wrong because blockbusting induces owners to sell by claiming members of a protected class are moving into the neighborhood. It targets sellers through fear, whereas steering channels buyers by protected class into or away from particular areas. C is wrong because redlining is a lender's or insurer's refusal to serve a neighborhood based on its composition. It involves financing or insurance decisions, not an agent directing buyers to particular neighborhoods, which is the practice of steering. D is wrong because puffing is lawful sales talk that merely expresses an opinion about a property. It is not a discriminatory practice at all, unlike steering, which unlawfully channels buyers according to a protected class. Steering is a fair housing violation in which an agent channels buyers or renters toward or away from certain neighborhoods based on a protected characteristic, race, religion, national origin, or another protected class. Understanding it means understanding why intent never excuses the conduct. Steering can be obvious or subtle. An agent might show minority buyers homes only in selected areas, describe certain neighborhoods to certain clients, or simply choose which listings to present based on protected class. Crucially, warm intentions are no defense. The law targets the channeling itself, not the motive behind it. Steering is one of 3 classic fair housing offenses. Blockbusting pressures owners to sell by stoking fears about a protected group moving in. Redlining denies loans or insurance in certain areas, often along racial lines. All 3 control where people can live based on protected characteristics, but steering is the one that works through the agent's selective guidance. When an agent steers, they substitute their own sorting for the client's free choice, narrowing the options presented because of who the client is rather than what the client wants and can afford. Fair housing law exists precisely to guarantee every qualified buyer the full open range of choices. On an exam, watch for an agent who limits or directs housing options by protected class, even when framed as kindness or helpfulness. Whenever a STEM describes sorting buyers into areas by a protected characteristic, the answer is steering, because good intentions never cure a fair housing violation. Question 41. Before recovering from the Pennsylvania Recovery Fund, what must an aggrieved consumer first obtain against the licensee? Your options are A. A commission license, B. A title insurance policy, C. A final court judgment, D. A homestead exclusion. Which one is it? Pause the video if you need more time. The correct answer is C. A final court judgment. C is correct because the consumer must first sue the licensee and obtain a final court judgment based on fraud, misrepresentation, or deceit, then attempt to collect and show it is uncollectible before applying to the court for payment from the fund. A is wrong because obtaining a commission license is irrelevant to a consumer's claim against a licensee. The consumer must instead secure a court judgment, attempt to collect it, and show it cannot be satisfied before applying to the fund. B is wrong because a title insurance policy protects against title defects, not against a licensee's fraud or deceit. Recovery from the fund requires winning and proving uncollectible a court judgment against the licensee, not holding a title policy. D is wrong because a homestead exclusion is a property tax benefit wholly unrelated to a recovery fund claim. The first step toward the fund is obtaining a final court judgment against the licensee for the wrongful conduct that caused the loss. The Pennsylvania Real Estate Recovery Fund isn't a first stop for harmed consumers. It's a backstop. Before the fund pays a single dollar, a specific legal process must be completed in a fixed order. The sequence is fixed and non-negotiable. First, the consumer sues the licensee and wins a final court judgment establishing liability. Second, the consumer attempts to collect from the licensee and comes up empty. Only third, after both prior steps, may the consumer apply to the fund. The fund is financed by licensee fees and exists to make whole consumers harmed by licensee wrongdoing, but only when the wrongdoer cannot pay. A court, not the claimant alone, must first establish that real compensable misconduct occurred. The judgment requirement is a filter. It prevents the fund from paying out on mere allegations, keeps the fund solvent for genuine victims, and ensures that only losses the legal system has already validated can qualify for payment. Remember, the recovery fund sits at the end of a process, not the beginning. The signal phrase on any exam is, must first obtain a final court judgment. Without that judgment, the fund has nothing to honor. Question 42. A colorless, odorless radioactive gas seeps from the soil through foundation cracks and is a leading cause of lung cancer. Which hazard is this? Your options are A. Carbon monoxide, B. mold, C. asbestos, D. radon. Take a second. Which answer would you pick? The correct answer is D. Radon. D is correct because radon is a colorless, odorless radioactive gas produced by the natural decay of uranium in soil and rock. It seeps in through foundation cracks and is a leading cause of lung cancer, and Pennsylvania has high levels. A is wrong because carbon monoxide is an odorless gas, but it comes from incomplete combustion in furnaces and appliances rather than from soil decay. The soil-borne radioactive gas described, a major lung cancer cause, is radon instead. B is wrong because mold is a fungus that grows on moist surfaces and causes allergic and respiratory effects in occupants. It is not a radioactive gas seeping up from the ground, so the description points to radon rather than mold. C is wrong because asbestos is a fibrous mineral that is hazardous when its fibers become airborne and are inhaled. It is a solid building material, not a gas rising from the soil, so the gas described here is radon. Radon is a naturally occurring radioactive gas that seeps up from uranium-bearing soil and enters buildings through foundation cracks, gaps around pipes, and some pits. Because it has no color and no odor, occupants have no sensory warning it is present. The gas accumulates in enclosed lower levels where it cannot disperse, and people breathe it for years without any warning sign. Regions like Pennsylvania, which sit on uranium-bearing geology, have especially elevated radon potential. The critical exam distinction is between radon and carbon monoxide. Radon is radioactive, comes from the soil through the foundation, and causes lung cancer over years. Carbon monoxide comes from faulty combustion appliances and causes sudden poisoning, a completely different source and timeline. When radon levels exceed the action threshold set by health authorities, mitigation is required. The standard system uses a vent pipe and fan to draw soil gas from beneath the slab and discharge it above the roofline, dropping indoor concentrations to safe levels. On the exam, whenever a question describes a colorless, odorless, radioactive gas entering through the foundation and linked to lung cancer, the answer is radon, every time. Question 43. On appeal of a commission adjudication, the Commonwealth Court generally reviews for what? Your options are A. Legal error and substantial evidence, B. A complete retrial of the facts, C. The licensee's popularity, D. Whether to set new fees. Before I reveal it, which one do you think is right? The correct answer is A. Legal error and substantial evidence. A is correct because on appeal, the Commonwealth Court reviews whether the Commission followed the law and due process, and whether its findings are supported by substantial evidence. It does not simply redecide the facts or substitute its own judgment for the agency's. B is wrong because the court does not conduct a complete retrial of the facts on appeal. It examines the record for legal error and asks whether substantial evidence supports the findings, leaving the fact-finding to the agency that held the hearing. C is wrong because a licensee's popularity is irrelevant to appellate review. The court looks at whether the law and due process were followed and whether the findings rest on substantial evidence, not at any measure of popularity. D is wrong because setting new fees is a regulatory matter, not part of appellate review. The court reviews the adjudication for legal error and for substantial evidence supporting the findings, not the establishment of any fees. When a party appeals a Pennsylvania State Real Estate Commission adjudication, the Commonwealth Court steps in, but its role is narrower than many expect. The court is not there to retry the case or reach its own conclusions on the facts. The court asks exactly two main questions. Did the Commission commit an error of law? And does substantial evidence in the record support the factual findings? Fact-finding itself stays with the Commission, the specialized body that heard the witnesses. Substantial evidence means enough relevant evidence that a reasonable mind could accept it as adequate to support the Commission's conclusions. The court checks whether that threshold is met. It does not reweigh the evidence or swap in its own judgment. This division of labor is the core framework. The Commission builds the record and finds the facts. The Commonwealth Court polices legal correctness and evidentiary sufficiency. If both pass, the court affirms, even if the judges themselves might have weighed the testimony differently. The lasting rule, appellate review of a Commission decision is deferential. The Commonwealth Court checks for legal error and substantial evidence, then affirms if both pass. It does not retry the case, rehear witnesses, or substitute its own view of the facts. Question 44. Which insurance protects a brokerage against bodily injury claims, such as a visitor injured at an open house? Your options are A. Errors and omissions insurance, B. General liability insurance, C. Title insurance, D. Mortgage insurance. What's your answer? Commit to one before I continue. The correct answer is B. General liability insurance. B is correct because general liability insurance covers bodily injury and property damage arising from the brokerage's premises and operations, such as a visitor injured at an open house. It addresses ordinary accident claims rather than professional errors. A is wrong because errors and omissions insurance covers negligent professional mistakes, like a failure to disclose a defect. It is professional liability coverage, not the policy that responds to a visitor's bodily injury suffered at an open house. C is wrong because title insurance protects against defects in the ownership of property discovered later. It addresses title risks tied to the transaction, not a physical injury suffered by a visitor on the brokerage's premises. D is wrong because mortgage insurance protects a lender against a borrower's default on a loan. It has nothing to do with injuries on the premises, which general liability insurance covers for the brokerage and its operations. General liability insurance protects a brokerage when a third party suffers bodily injury or property damage connected to the business. It covers legal defense costs and any damages owed up to the policy limits. This is the coverage built for the everyday physical risks of inviting the public onto properties and into the office. Picture a visitor who trips and breaks an arm at an open house. That physical injury to a member of the public is exactly the scenario general liability exists to handle. The insurer steps in to defend the brokerage and pay covered damages, so the firm does not bear those costs alone. The policy responds to bodily injury and property damage suffered by third parties, visitors at open houses, passers-by at listed properties, or anyone whose property the brokerage damages. It pays for legal defense and covered damages up to the policy limits. The critical exam distinction separates general liability from errors and omissions insurance. General liability handles bodily injury and property damage to others. Errors and omissions covers professional negligence, financial harm from a mistake in advice or paperwork. Physical harm to a visitor points to general liability. A client's financial loss from bad advice points to E&O. When an exam stem describes a visitor hurt at an open house or physical damage to someone's property, the answer is general liability insurance. That signature scenario, a broken arm, a slip and fall, is what this coverage exists to address. Question 45. A listing in which the broker keeps everything above a price the seller names creates a clear conflict of interest. What is this listing called and how is it treated? Your options are A. An open listing, fully encouraged. B. An exclusive listing, always required. C. A net listing, restricted or prohibited. D. A buyer agreement, standard practice. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. A net listing, restricted or prohibited. C is correct because a net listing lets the broker keep anything above the seller's name price, tempting the broker to underprice or hide value. Because it creates a glaring conflict of interest, net listings are restricted or prohibited in many states, and a Pennsylvania licensee who uses one risk discipline for breaching the duty of loyalty to the seller. A is wrong because an open listing pays the procuring cause broker and is a legitimate arrangement, not the conflict described. The listing where the broker keeps the excess over a name price is a net listing, which is restricted rather than encouraged. B is wrong because an exclusive listing engages one broker and is common, but it is not always required and is not the conflict described. The arrangement letting the broker keep amounts above a named price is instead a net listing. D is wrong because a buyer agreement creates buyer representation and is standard practice, unrelated to the seller-side conflict at issue. A listing letting the broker keep the excess over the seller's price is the net listing. A net listing is a specific arrangement where the seller names a price they want to walk away with, and the broker keeps everything above that figure. This structure is unique and uniquely dangerous because it turns the broker's financial gain against the seller's interest. Here's the core problem. The broker profits most when the seller's net is set low. That incentive tempts the broker to use superior market knowledge to mislead the seller, exactly the self-dealing that fiduciary law forbids. Visually, the danger is clear. The broker's commission is literally the gap between what the seller asked for and what the property sells for. The bigger that gap, the more the broker earns, and the more money the seller may have left on the table without knowing it. Standard listing forms, exclusive right to sell, exclusive agency, open listing, all pay the broker a percentage of the sale price. So the broker earns more only when the seller earns more. The net listing breaks that alignment entirely, which is why it stands alone as restricted or prohibited. Regulators restrict or prohibit net listings because the arrangement invites a broker to breach the duty of loyalty owed to the seller. On any exam, when you see a broker keeping everything above the seller's stated figure, recognize it as a net listing and flag the fiduciary conflict built right into its structure. Question 46. A broker is responsible for establishing policies, training salespersons, and monitoring trust account handling and advertising. A failure to do this is itself what? Your options are A protected business decision. B, the salesperson's sole responsibility. C, an antitrust matter. D, a violation the broker answers for. Which would you go with? Lock it in before the reveal. The correct answer is D, a violation the broker answers for. D is correct because a broker is responsible for supervising the brokerage and its licensees. A failure to supervise is itself a violation for which the broker can be disciplined, even where the broker did not personally commit the underlying wrong. A is wrong because supervision is a legal duty, not a discretionary business decision a broker may simply forego. Failing to oversee the brokerage and its licensees is a violation that can lead to discipline against the broker personally. B is wrong because supervision is the broker's responsibility, not solely the salesperson's burden. The salesperson works under the broker's oversight, and the broker can be disciplined for failing to supervise the office and its licensees. C is wrong because an antitrust matter involves agreements that restrain trade, such as price fixing among competitors. A failure to supervise is a distinct breach of the broker's oversight duty, not an antitrust issue at all. Every licensed broker carries a personal, ongoing duty to supervise the brokerage. This duty cannot be delegated, and neglecting it is a violation in its own right, completely separate from whatever a salesperson may have done wrong. Supervision means establishing clear written policies, providing real training and guidance to salespersons, and actively monitoring trust accounts and advertising. These are the broker's personal responsibilities, not optional tasks that can be handed off. The broker holds the license the entire office operates under. Salespersons act in the broker's name and handle other people's money. The law places accountability at the broker, so the public has one responsible party keeping the firm in line. When a salesperson mishandles escrow funds or runs a misleading ad, the broker faces discipline for the supervisory breakdown, not for personally committing the act. The breakdown in oversight is the broker's own independent violation, regardless of the salesperson's separate accountability. The key exam insight is this: a broker is not only liable for personal misconduct. Whenever a STEM describes a broker ignoring policies, training, or monitoring, that neglect itself is the violation the broker answers for. Question 47. A salesperson holds out genuine competence in structural engineering and gives an opinion that proves wrong, harming the client. What risk does this create? Your options are A. Liability for negligence or misrepresentation. B. No risk, opinions are free. C. Automatic license revocation. D. A tax penalty. Don't overthink it. Which one feels right? The correct answer is A. Liability for negligence or misrepresentation. Is correct because holding oneself out as competent in a specialized field one does not actually command exposes the licensee to liability for negligence and misrepresentation. The professional standard is to serve within your competence and refer matters beyond it to experts. B is wrong because the idea that opinions are free ignores the harm a false claim of expertise can cause a client. Overstating competence in a technical field exposes the licensee to liability for negligence and misrepresentation when the client relies on it. C is wrong because license revocation is a possible discipline for serious misconduct, but it is not the automatic result of overstating expertise. The immediate exposure described is civil liability for negligence and misrepresentation, rather than an automatic loss of license. D is wrong because a tax penalty has nothing to do with overstating one's professional competence. The risk from claiming expertise the licensee lacks is liability for negligence and misrepresentation, not a consequence imposed by any tax authority. When a licensee holds out genuine competence in a specialized field, the law holds them to the standard of that claimed skill, not just the standard of an ordinary agent. Because the client is entitled to trust a professional's assurance, the law raises the bar. The licensee is no longer judged as a layperson. They are judged against the standard of the expertise they claimed. Exposure arises along two related lines: negligence, when the licensee fails to exercise the care their claimed skill implies, and misrepresentation, when a false statement, even an innocent one, causes the client to act to their detriment. Picture a salesperson who tells a buyer the foundation is perfectly sound, claiming structural expertise. The buyer skips a professional inspection and buys. When the foundation fails, the salesperson faces liability because the buyer reasonably relied on an expert assurance. The lasting lesson: stay within your actual competence and refer specialized questions to the right professional. Overreaching by holding out skills you don't possess is precisely what converts ordinary advice into actionable negligence or misrepresentation. Question 48. A buyer won a $35,000 judgment against a broker for fraud but cannot collect it. How much may the buyer recover from the recovery fund? Your options are: A. The full judgment amount. B. $20,000. C. Nothing at all. D. $100,000. Got a guess? Lock it in. The correct answer is B. $20,000. B is correct because the fund pays a maximum of $20,000 per claim. So the buyer recovers $20,000 and the remaining loss is not covered. The broker's license is then suspended until the fund is repaid in full with interest. A is wrong because the full judgment is not recoverable, because a per-claim cap applies to fund payouts. The fund pays at most $20,000 on a single claim, leaving the remainder of the judgment uncovered for the buyer. C is wrong because the buyer is not barred from recovering anything from the fund, holding an uncollectible judgment for fraud. The buyer may recover up to the per-claim maximum of $20,000 from the recovery fund. D is wrong because $100,000 is the aggregate cap against one licensee across all claims, not a single claim amount. This buyer's one claim is capped at $20,000, so the larger aggregate figure does not apply. The Pennsylvania Real Estate Recovery Fund protects consumers harmed by licensee wrongdoing, but its protection has a hard ceiling. Understanding how that cap works is essential for both the exam and real practice. The process has 4 steps. First, the consumer must win a final court judgment. Second, they must fail to collect it from the licensee. Third, the fund pays the established loss, but only up to its $20,000 per claim ceiling. Fourth, any amount above that ceiling remains owed personally by the licensee. Picture a buyer who wins a $35,000 fraud judgment but cannot collect a cent. The fund pays $20,000, its per claim ceiling, and the remaining $15,000 stays a personal debt the broker owes. The fund's responsibility ends precisely at its statutory limit. The cap exists to keep the fund solvent for many victims rather than exhausted by a few large claims, because it is a finite pool financed by licensee fees. Capping recovery per claim spreads the protection so the fund can respond to injured consumers over time. Whenever an exam stem gives a judgment above the ceiling and asks what the fund pays, the answer is the statutory maximum of $20,000. The judgment opens the door, the cap measures the room. Question 49. A buyer's agent is paid out of the transaction proceeds rather than directly by the buyer. Does the source of payment determine whom the agent represents? Your options are: A. Yes, the payer is the client. B. Yes, payment always controls. C. No, representation is set by agreement. D. Only in an open listing. Which one is it? Pause the video if you need more time. The correct answer is C. No, representation is set by agreement. C is correct because the source of compensation does not by itself establish whom a licensee represents. A buyer's agent may be paid from the proceeds yet still represent the buyer, since representation is set by the agreement and disclosure. A is wrong because the payer is not automatically the client. Representation is established by the written agreement and disclosure, so a buyer's agent paid from the proceeds still represents the buyer rather than whoever happens to fund the fee. B is wrong because payment does not control representation at all. Who writes the check does not decide whom the licensee represents, because that question is answered by the brokerage agreement and the disclosure. not by the source of money. D is wrong because this principle is not limited to open listings. In every transaction, the source of compensation fails to determine agency because the controlling factors are the written agreement and the disclosure of the relationship. In real estate, who an agent represents is determined by the agency agreement, not by who writes the check. This principle is fundamental, and understanding it prevents a very common and costly mistake. Representation and compensation are two completely separate things. The agency agreement establishes who the agent works for, creating duties of loyalty, confidentiality, and care. Compensation is simply a financial arrangement, and it can flow in many directions without altering those duties. Here you can see how the commission might flow from the seller's proceeds to the buyer's agent at closing. Yet the fiduciary duties created by the buyer-agency agreement run entirely to the buyer. The money's path is separate from the loyalty's path. Think of it in 3 steps. The agency agreement is signed first and fixes the agent's role. The commission flows later at closing, often through the seller's side of the deal. But because representation was locked in by the earlier agreement, the later movement of money leaves it completely untouched. Whenever an exam question describes a buyer's agent paid from transaction proceeds and asks who the agent represents, remember the agreement controls, not the check. The buyer's agent represents the buyer because they agreed to, and no ruling of the commission can change that. Question 50. In Pennsylvania, the legislature writes the statute and the State Real Estate Commission writes the rules that implement it. What are the commission's rules called? Your options are A. The Licensing and Registration Act, B. The Recovery Fund, C. The Consumer Notice, D. The Commission's Regulations. Take a second. Which answer would you pick? The correct answer is D. The Commission's Regulations. D is correct because the General Assembly writes the statute, the Real Estate Licensing and Registration Act, while the State Real Estate Commission writes the regulations that implement it. The Commission's regulations have the force of law and bind all licensees. This is wrong because the Real Estate Licensing and Registration Act is a statute written by the legislature, not the Commission's rules. The Commission instead adopts regulations to carry out that act, and those regulations are what the question describes. B is wrong because the Recovery Fund is a consumer protection account that reimburses victims of licensee wrongdoing. It is a remedy the Commission administers, not the body of rules the Commission writes to implement the governing statute. C is wrong because the Consumer Notice is the agency disclosure document given to consumers at the initial interview. It is a required disclosure form, not the regulations the Commission adopts to implement the licensing statute. In Pennsylvania real estate law, there are 2 distinct layers of binding rules. Understanding how they relate and who creates each is essential for any licensee. The legislature enacts the statute, the broad law setting policy and granting authority. The State Real Estate Commission then adopts regulations, the detailed rules that carry the statute into practice. Both layers are binding on licensees. The legislature delegates the detailed work to the Commission through a mechanism called delegated rule-making. The statute grants the authority, and the Commission uses that authority to write specific enforceable rules, like trust account handling or disclosure requirements. Regulations are not mere suggestions. Once properly adopted, they have the full force of law. A regulation must stay within the authority the statute grants. It cannot exceed or contradict it. Violating a regulation is just as much a basis for discipline as violating the statute itself. The key exam skill is matching the source to the label. Whenever a question describes the agency adopting detailed, implementing rules, those are regulations. The broad law passed by the legislature is the statute. Both bind, both discipline. Just know who wrote which.
You have reached the end of our first question set. For the free complete exam preparation, visit our website link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.